welcome on board Mark Matthews and talk about what he's making of global markets at this juncture. Mark, hi. You've got the Jackson Hole Symposium this evening. It's not the traditional two-day event, but a one-day one at that, and online this time around. Just wanted to understand, what is your expectation? Because while it seems at one hand that a taper tantrum could well be in the price, but I was just looking at the 1-month returns after the Fed taper announcement back in 2013 and how the various asset classes actually perform. The India benchmark Nifty fell 7.5%. So was the price action on the rupee as well. Gold was down, crude was down, copper, silver as well, all posted losses. Put that into context as to how things look at this time around and whether or not there is any chance of a taper tantrum.
I suppose there is one, because the market is not expecting one, and usually what takes the market down is the things that it's not expecting. That makes sense, because the things that it's not expecting aren't in the price. But I don't think that's going to happen this time. I think that the speech that Jerome Powell will give 10 a.m. New York time on Friday will be just a reiteration of what they've said so far, which is that the taper is coming, but he won't give specifics. The specifics, I think, will come on the FOMC meeting on the 22nd of September. And so there's a few reasons for that. One is he's going to be reappointed on around the Labor Day weekend, which is the 6th of September. So why would he want to upset the apple cart just before he's going to get reappointed by making some announcement about tapering at Jackson Hole? But I do think it's coming because, interestingly, there were 3 Fed officials who said as much yesterday. James Bullard is always hawkish, so I wouldn't read too much into him. But Esther George put in her 2 words. And then Robert Kaplan, who just on Friday last week said he was thinking about not doing tapering. He said actually his business contacts were telling him things were good enough that go ahead and do it. And by the way, I'll say one last thing. The daily case counts for COVID look like they're still rising in America. But you might remember in India when the terrible wave happened in March and April, that it was Maharashtra that went up first, and it was also Maharashtra that peaked and rolled over. Well, we're seeing that now in the southern states, Louisiana, Arkansas, Mississippi, Texas. Their COVID cases are dropping very sharply. And so first in, first out. I think you're going to see by the Fed meeting in September probably about 40% less COVID cases than today. So that then they would have an excuse to go ahead and announce the specifics and the timing.
Mubina as well joining in. Yeah, makes sense. You've got that Labor Day weekend. You don't really want to sort of be the bearer of bad news ahead of that, I guess. And yeah, I guess by September you'll have more certain cues, not just with respect to the other economic indicators, but more importantly with respect to the virus spread in the United States. And I think that as well will have a very much of a bearing. So Mark, we know that it's not a question of it's a question of when. So how do you position yourself then whenever that is, whether it's right now in the Jackson Hole Symposium or later in September? How would you position yourself in terms of assets that you own?
Well, we don't think there is going to be a taper tantrum, and I suppose there's two reasons I can think of off the top of my head. The one is that if you look at the government bond auctions in America, but in Europe and around the world, there's still a tremendous amount of demand for so-called safe investments. And so that demand will naturally keep interest rates low. And the second thing I would say is the US government is highly indebted, and it's going to become more indebted to finance Joe Biden's infrastructure stimulus plans. So it's not in the interest of the government to see rates go up And therefore, unless there's a very compelling reason to make them go up, like inflation, which I do not think will be persistent, then the rates will stay low. And so to answer your question, how we would be positioned in that kind of environment is in the defensive and growth stocks, because historically, those are the ones that do well in a low interest rate environment. And I might also add in what we think we're in now, which is we call it a mid-cycle slowdown, where the purchasing managers' indices are peaking and rolling over. And so in a few months, we will see similarly GDP growth peaking and rolling over. And in that kind of environment, defensive and growth typically outperforms.
Okay. Mark, you mentioned that interest rates are not going to go up in a hurry, because obviously the US is one of the most indebted economies out there. But at the same time, of course, tapering may still come through, a gradual one at that. So how would you position yourself on the dollar index? Because if the Fed says that, look, I'm not going to be pushing in that kind of money into the system, we will see a dollar spike. But at the same time, if interest rates are continuing to stay at the rock bottom levels, so what would be your take on the dollar index then?
I think it's going to weaken because of what you just said, and also because Europe is actually growing faster than the U.S. right now, and actually their COVID is just going like that. They didn't have a big wave. So the euro is 2/3 of the dollar index, and I would expect the euro to do better than the dollar based on what I just told you over at least the next 3 months. So to answer your question, we'd look for the dollar to be weaker, but also because globally we think there'll be a continued improvement in risk appetite. And typically when you have an improvement in risk appetite, people go to other countries outside of the US, and that makes the dollar go down.
Okay, Mark, but right now what we've been seeing, for example, in India, we've been seeing outflows by FIIs. FIIs have been consistent net sellers. Now, it's not really something that's hammering the markets, obviously, but it's an irritant. So what what explains that? I mean, is it the expectation that, look, we're not going to have as much liquidity as we did have for the most part of the last 2 years? Is it a preemptive action by FIIs when they slowly start to pull out from India and some of the other EMs as well?
I don't have a good answer because I certainly would not sell India. My only guess is that it could be related to China, in that a lot of people would have owned China by having exposure to emerging market ETFs and funds. And so if they feel time to get out, I don't like what I hear over there, then when they sell that ETF or managed fund, obviously the price goes down. It's the only thing I can think of that would explain it. Yeah.
Sure. So, Mark, I mean, has the time come to tactically align your portfolio? I mean, sure enough, the markets can't go one-way move up, right? There are bound to be dips and, volatile bouts. Given how strong the rally in metals has been, would you say as such the trade is intact, or would you say maybe ease off because metal stocks across the world, not just here in India, have only seen a one-way move up, and because of the globally linked nature, perhaps easing off or profit taking a little bit would make sense?
Yes, I would think so. I think the broad commodity complex actually is putting in a top. And why is that? Because there's an old saying in the commodities market: the cure for high prices is higher prices. And I think that prices just got so high that they became unaffordable for many buyers. And so we've seen that. I think we've seen that in several commodities, including copper. The other thing just to say is that the Chinese, clearly the headlines on China have been related to their regulatory moves against their consumer technology companies. But something else very big is happening, which is they are really trying to take the steam out of their property market, property sector. In a way, I don't think they've done before. They've never really dared to be too tough on property because it's about a quarter of GDP. But this time, I think they're really serious because it's part of this whole move in China to try to equalize wealth. The people at the top, clearly, this is their number one priority. And property prices, in their view, are a major exacerbating factor behind the inequality in society. So they want to bring property prices down. And so just purely on that basis, I would imagine there'll be less demand for the things that go into property, like steel and copper, from China. And it's the largest buyer of iron ore and the largest buyer of copper in the world. Longer term, obviously, with copper, there's a special thing, which is electric vehicles. But I think that's probably a 10-year story, not a 3-month story.
You know what you said about Chinese property markets, that's not quite true with India, because be it the demand or for that matter, even prices in select pockets, they seem to be actually holding up pretty well. What is your view on how the Indian real estate market should be looked at? Interest rates are low. Some of the state governments have also reduced taxes on buying new residential property, and all that has culminated into property demand actually almost getting close to their pre-COVID peaks. What is your own sense on whether or not this makes for good investment, though?
I'm very positive on Indian property for the reasons that you just mentioned. The interest rates are low. Property prices have been coming down for the better part of the last decade. So I think they're affordable to many people, and there's a lot of demand. And I think there is a lot of people who are seeing their wealth grow in various segments of the economy, but the new economy in India is developing rapidly. The economy is digitalizing as a whole. And so the demographics are favorable in terms of a young country, young population. Yes, I like real estate in India.
Yeah, in fact, we were just making that case, with the kind of hiring as well we are seeing in a sector like technology, with the perks that are being offered, it does make a case that with this, with the increase in employment, with the improvement in employment numbers, realty would stand to benefit. People would look to upgrade their lifestyles and their living statuses. So, Mark, you've made a case for interest rates staying low. You've made a case for the dollar index as well going down, and that how investors' risk appetite will increase. Would it be correct then to surmise from these statements that you're not exactly optimistic on gold? And if that's so, for those individuals holding gold ETFs, does it make sense then to reduce their positions there?
Gold did so well last year because of COVID, and I think that it's given back enough. I wouldn't be a seller of it. I think it's a nice thing to have in somebody's portfolio. It has held its own against inflation over the years. Would I go out and buy it today? There's not a particular need, but I have always said that if you don't have it, it's nice to have a little bit in your portfolio, somewhere between 5 to 7%. But today, tomorrow, no urgent need, I think, to either buy or sell it. To me, I see it kind of going sideways, but it seems to have actually perked up a little over the last few weeks.
That it has. In fact, I think as we speak, it's just about hovering near that $1,800 per ounce mark. And fair enough. The role that gold plays, it's like a hedge, a 5 to 7% investment in gold really makes prudent sense as well from an overall portfolio perspective. Now, Mark, in the event that we do have a third wave in whatever form it comes, because like you said, we've been seeing pockets in the US. Yes, we may see a good recovery in some of the southern states where we are seeing an emergence, but Australia is becoming a bit of a problem. The last 2 days numbers in India too, well, not looking so good really. What has been the playbook? I mean, do you think the markets are more experienced in knowing how to deal with a resurgence? Because we've seen it happen last year, this year too. So what usually has been the playbook? How would it work then?
It won't be the same as previous times, and because the vaccinations are changing the game. And I think the evidence is infallible that the vaccines work. I just saw the CDC published a report Monday, you could Google it, on a study they did in Los Angeles County, primarily during the month of July. And it just found that if you're vaccinated, your chances of getting ill were 1/10 or something of what they were, or actually much less, and chances of being in the hospital, much less, teeny fraction. So I think that in countries that are highly vaccinated or where the rates of vaccination are rising quickly, and I need to be careful how I say this because I know so many people have been so grievously affected by this horrible virus, but I think that for highly vaccinated populations, it's becoming something like a bad flu. And you could get sick, you could get quite sick, but not usually sick enough to go to hospital, just like having a very bad flu. And so I think the market can actually live with that. Chances are, obviously, if you're vaccinated, you won't get sick at all. But occasionally that happens. And so the countries which are lagging on vaccinations, you mentioned Australia, but Australia is picking up. They're doing about 1 million people a day now. Are going to have to stay locked down for longer. But somehow the markets, as you well know, have been willing to look through this from not the get-go. Initially, we collapsed, obviously, when we realized this was a global pandemic, but very quickly they put in a bottom. And unless somehow a new variant emerges that really changes the game, in other words, much more breakthrough cases in vaccinated people and much bigger increase in fatality, I suspect the market will be willing to look through another wave again this time.
Fingers crossed on that one. Mark, just stay with us. I'm going to take a quick commercial break and be right back and continue my discussion with you. Okay, back with the market right here in ET now. A little bit tempered. We're just, skirting around that 16,600 mark. The breadth, though, at least for now, is in the positive. Let's see which way it heads moving on from here. But Mark, just on the subject of IT, I mean, be it India, be it globally, we've all seen how IT stocks have performed. Given the kind of growth, and, I was just chatting about this with someone yesterday pertaining to how India businesses have been panning out. Even traditional Indian businesses are now moving to digital, and that only spells big opportunities for IT companies. I mean, time and again you think that the valuation has run up too much, the stocks are sitting extremely expensive, but the scope, the business, the opportunity for IT only gathers more and more momentum as there is deeper penetration when more and more businesses are converting digital. What are you making of the IT opportunity in India, and whether or not we should even be looking at valuation as a parameter?
So the first thing I'd say is that these companies have benefited from COVID, and the digitalization of the economy that was happening anyway has been accelerated. And when COVID goes away, that won't stop. Obviously, we will go back to more meeting in person and that sort of thing, but the building blocks have been put in place. And so because their earnings growth has been so strong, if you look at, I'm just picking names out of a hat, but if you look at Facebook or Google or Apple or or what is the other one I'm thinking of? Anyway, those kind of companies, Microsoft, they're trading at between 20 to 30 times forward price earnings, and they have returns on equities of anywhere from 20 to 30%. So how can you not like that? That's not expensive. It isn't for such companies that are involved, as you rightly say, in digitalization, not just of the American economy, but the world economy, excluding China. So China set up its own companies to do these things. Now, going forward, I think that in India and other countries, the government will say to those kind of companies that I just mentioned, you've already made so much money in our country. From now on, we want you to share some of the business with the locals. And I think we've seen the beginning of that with Reliance. But going forward, I think there'll be a lot more Indian companies benefiting from the digitalization of India. And I know that the private equity scene is very hot there right now, particularly a lot of capital raising in technology, and so that's providing fuel to the listed equity market too. And there's a very big IPO pipeline
Sure.
of technology companies.
Yeah,
So yes, I think it's a very promising.
it sure is. Indeed. Mark, such a pleasure having you on the show today. Thanks as always for dropping in.